Well, hi there, everyone. Little late start today for Chart This with Dave Keller, but I appreciate you so much joining me on this special Friday all mailbag edition. I had a lunch in Seattle that went a little late, and Seattle is a little ways away from where I'm at here, just east of Redmond, Washington. So apologize for the late kickoff, but I appreciate those of you willing to tune in live. And if you're watching the replay sometime over the weekend, I very much appreciate you as well. I'm Dave Keller, host of Market Misbehavior, coming to you from a very rainy and somewhat hail-like Redmond, Washington. We just had hail a little bit ago. Not baseball-sized hail, but little bits, but big enough for rain. Market certainly finishing the week with a whimper, very close to ending Q1 of 2025 in a position of weakness. We've not had a down Q1 in quite some time. Something we'll probably be talking about, certainly with my Market Misbehavior premium members next week for our monthly chart review for April, as we dig into some of the nuances about how the first quarter has gone. But certainly today seeming to be an exclamation point on the distribution phase that we've been observing here recently. We're going to do a quick market update with some initial reaction to what we saw today. Quickly go through a couple charts, and then I'll get to some questions. I grabbed 5 or 6 great questions from all of you from the last couple days. All of these questions have come from viewers like you watching the show, throwing questions in as we go, either live on our live stream or on our YouTube channel in the comments section. Please keep them coming because I appreciate you so much. Sharing what you're looking at, what you're struggling with, what you're trying to answer, because that helps me make sure that this show remains relevant for all of us. Plenty to talk about, so let's get to the market recap and see how things played out today. And it wasn't great, as I'm sure you know by now. The S&P down another 2%. We closed around 5580, so we're still above that 5500 level. That was the swing low from earlier in March. I think that's the key line in the sand. And by the way, we'll look at a couple charts here, but I did post an article to my stock charts blog, which is called The Mindful Investor, just earlier today, talking about a potential downside target in the S&P 500 and how we derived it. So make sure you tune in there if you like. I'll try to remember to put a link to that one as well. All right, continuing on, the NASDAQ composite down almost 3% today, the worst performer of this basket of indexes. NASDAQ down 2.7% to 17,323, we'll call it. Mid caps and small caps down as well. The small cap index down over 2%. That's the S&P 600, the Russell 2000, pretty similar. The VIX actually moving up by almost 3 full VIX points, and we do get above that 20 threshold. That's that sort of back of the envelope, high or low volatility kind of threshold. We're back in the high volatility range, suggesting a period of distribution. So while, no major support levels were broken, I would say what we saw today certainly seems to confirm the fact that we've now had either a brief push above the 200-day before failing, or a failure to get to the 200-day before rolling over. But the end of this week certainly appears as if we are beginning another leg down. At least that's how I'm interpreting it for now. Looking at the fixed income markets, you can see bonds actually higher today, while stocks were going lower. The TLT ended up around 1.4%. The 10-year yield brought down around 4.25%. The long bond yield around 4.63, and the 5-year yield below 4%. So we're seeing weaker stocks, stronger bonds, maybe a flight to safety in the bond markets. Dollar, not much of a change from yesterday. In the commodity space, gold continues to go higher. We've talked about gold. I own GLD and IAU in my accounts. Don't see a reason to change that position anytime soon, particularly given the instability and flat out bearish rotations we've seen in a lot of risk assets like equities, like cryptocurrencies, certainly growth stocks. So pretty happy with the position in gold for now, up another 0.7% for the GLD, another new all-time high for gold to finish the week. Looking at the cryptocurrency space, all in the red, similar to what we saw from equities. And you can see Bitcoin currently down around 3,000 points as we go live here, down about 3.4%, Ether down over 5%, and all the other top 10 coins all in the red. So very much a distribution day. And again, kind of a rough finish to the week. Inflation data before the open was really the story here. This is the PCE, the personal consumption expenditures, which is the Fed's preferred way of measuring inflation. And it popped higher than expected, and that's going to cause things to go down, which we definitely saw. The utility sector actually in the green today. So keep in mind, one of the things we've talked about is looking at the relative performance of defensive sectors as a way of identifying when we have another big rotation lower, because we've seen that counter trend move over the last couple weeks of growth stocks leading higher, and a lot of the defensive sectors pulling back a little bit after outperforming consistently in 2025. It's kind of what happened today. Utilities up about 0.7%. REITs, number two, basically flat for the day. Healthcare down slightly, about 0.33% from Thursday's close. Those are your top three performers. On the bottom, the three FANG sectors, and they were all down a pretty good amount here. The XLY down over 3%. Once Tesla's not going up, it's hard for the XLY to mount any sort of significant upside. We're seeing that today. Communication services, which has been the best of these three on a relative basis here to date, for sure, has outperformed the S&P, down about 3% today. Technology, which has been an underwhelming relative performer year to date, down another 2.4% today. Elsewhere, no change in our market trend model, appears to be remaining steady at bearish in the short term and medium term, and still bullish on the long term. The breadth was pretty negative today, 80% down days for most of these indexes, a 90% down day for the small cap index. So while you could make an argument that moves to more value-oriented sectors could be great for small caps, not happening right now. It's sort of the risky, the higher beta nature, the higher risky part of the small cap story is what's hurting it the most here. So certainly a broad distribution day today by any stretch of the imagination. Looking at the Magnificent Seven and friends, the best of this bucket was NVIDIA, down 1.6%. That was your best. Broadcom down 1.7%. Broadcom has just blown through its 200-day moving average, and instead of getting any sort of bid to go higher, it's finishing in a position of further weakness. Alphabet down almost 5% today. Netflix, which has been the best of these charts, I think clearly down 4.4%. Meta down 4.3%. Same for Amazon. Meta still above its 200-day moving average, but really close to not being above its 200-day. So that was the distribution that we observed today. Let's look at the market carpet. There's a lot of red. So on a day like today, the index is down a lot of stocks down a lot, as we saw 80% or so in the S&P in the red. So you'll note the growth sectors certainly feeling the biggest weakness, right? And you can see the biggest names seem to have the worst days. So technology pretty much across the board, and except for Enphase Energy and a couple others like Motorola, Tyler Technologies, First Solar, Juniper, everything else was down a little bit to quite a lot. And names like Palantir and others, where I know there's a lot of optimism that those just recover and retest their all-time highs, finishing weaker today. Palantir down almost 5%. Apple and Microsoft, the two biggest names, down over 2% today. Same story for consumer discretionary, same story for communication services, where it's more the defensive stuff like the big telecom names that were down the least, but nothing particularly great there. So what did do well, right? In a down day, you look for the opposite. You look for things that actually managed to do well. Within the healthcare sector, not bad, right? Eli Lilly, United Healthcare, Johnson & Johnson, the three biggest weights in the XLV, all flat to slightly higher. AbbVie, Merck, Bristol Myers actually having an up day. Consumer staples, not too bad. Dollar Tree was pretty bad. Target was down, but most things were kind of flat or up slightly there. Utilities, certainly the best of this group. Also real estate, with a lot of the names certainly in the green. Within financials, I'm noticing like Progressive, one of the insurance companies. Insurance has probably been the best place to sort of hide out within the financial sector. But again, overall, this is a very much a distribution day. I'm noting the strength in defensive sectors, and that, along with this breakdown of the S&P, certainly feels like a signal that there's more downside to be had. I wouldn't imagine that today's drop was it. It could be, but I don't see that as the likeliest scenario. Here's Meta. Meta actually briefly traded below its 200-day moving average today. It did close slightly above it, almost exactly at the 200-day, to be honest with you. But we've talked about how these the Magnificent Seven names have just gone from exceptionally strong at the beginning of this year to now exceptionally weak. And names like Meta and Netflix are the outliers in that they haven't broken down through their 200-day moving average just yet. Meta's kind of there. I would say this is arguably the most important thing to watch in this group, is to see if we can hold the 200-day going into next week. I would hazard a guess that's probably not going to happen, but we'll see. A lot of growth stocks look like Apple, and Apple's just not a good chart right now. Now, it's not an end of the world horrible downtrend chart, and that's the reality, right? And I think that's where some people, that are still sort of bullish, see this as just a corrective move. And you're right. I mean, I guess the question is, do you want to ride Apple down 10, 20, 30% for the promise to go up another 50% later? And I'd probably like to avoid that and then get back in at a better level. And that's why this seems like, to me, a clear downtrend phase of lower highs and lower lows. I get excited about a chart like this when it stops making lower lows, when it stops making lower highs, when it gets back above the 200-day. Those are things that I can't use to describe Apple right about now. I was asked by one of my premium members earlier today about gold stocks, gold miners, copper miners, and different areas of the market. Certainly some of these charts looking incredibly strong, right? Kinross Gold is one of the gold mining names. If you know, like the GDX, it's these types of stocks that you're getting exposure to. Overall, general takeaway, this is a strong chart. Things that are strong, we're making higher highs and higher lows. We're above two upward sloping moving averages. I shared that scan, I think, earlier this week on stock charts, where the moving averages are in the correct order. The 20-day EMA above the 50-day simple moving average, the 50-day above the 200-day. Charts like KGC will come up on those screens today because they have that configuration. Not a lot of charts have that configuration. A lot did in mid-2024. Very few do at the end of the first quarter of 2025. The relative strength is incredibly strong. Year to date, look at how this has outperformed. That was a webcast we did earlier this week, was focusing on names demonstrating strong relative strength. That's why that's so important in this particular environment. There's only thing that concerns me is a bearish momentum divergence, potentially, because we're still kind of going up. So this could end up not being much of a divergence. But for now, I'm noting that new highs are being met with weaker momentum. Maybe that means we're near the end of this uptrend phase. But for now, charts like this are the kind of charts I probably want to own, as opposed to other things that are just flat out going down. Things not going down are pretty valuable right about now. I think that value of that type of chart has been elevated. That's kind of where I'm at. Some initial thoughts about the markets as I try to make sense of what we saw today. Certainly over the weekend, I'll be working up what I call my weekly flight plan, which is my main report that I do every weekend for my Market Misbehavior premium members. We'll talk a lot about S&P downside objectives and about positioning and about different rotational elements to go through. All right. For today, let's get going with the questions. Again, thanks so much, all of you, for putting questions in during the live stream, for putting questions in when you watch the replay. Really awesome to hear from you guys. I try to reply to every question that I get, certainly in the comments on my YouTube channel, just to acknowledge I saw this. I appreciate you watching, and I appreciate you asking questions. Some of those questions I bring in for our all mailbag episode. And let's get to question number one. Dave, when you talk about follow through after a key level has been reached, can you quantify what type of move confirms as follow through? Yeah, I really appreciate you asking about this. I regularly get questions about what I call follow through moves or follow through days. And the answer is I'm actually not super strict with that. And I'll tell you like an example. I'm just trying to find like a good example of it. I probably should have prepared ahead of time for this, but this is a proof that I'm really not doing much before the show besides getting ready and then just taking questions as we come. So, follow through days. So the reason why follow through is so important, as I probably mentioned before, a number of the mentors that were super important to me to this day, but certainly early in my career as I was trying to figure out the markets and how to analyze them and the whole technical analysis thing. People like Ralph Ekampora, John Murphy, John Bollinger, Tom DeMark, Larry Williams. These were legends that I'd heard of, whose books I read, who I had the opportunity to meet and try to ask as many questions as I could. And specifically, John Murphy, who wrote the first book I ever read on technical analysis of the financial markets. Tom DeMark, Larry Williams, whose work I've followed and I've been able to work with at times in my career. They all had a concept of follow through. And what was genius about, I think, this idea is you will often identify a key level, a key line in the sand, like a point, a signal that you're waiting for. And I always think a signal of any sort has three pieces. There's the setup, there's the trigger, and then there's the confirmation. Three parts to it. So the setup is this is electronic arts. We're getting up toward the 200-day moving average. So the setup is we're getting near the 200-day. I want to kind of see what happens when we get there. The trigger is we close through the 200-day moving average, right? We actually have a valid breakout above that level, right? A not just an intraday move, but a close that pierces that level and completes a breakout. But that third piece is what you're asking about, which is confirmation, follow through. Once you have that initial move, what happens so often is you have an initial break above the 200-day, and then it just completely stalls out, right? Look at where we had that breakout day, and then we just completely stopped, right? We haven't gone further. We've sort of just remained range bound, and we haven't really continued that move. And so behaviorally, what that tells me is people are all excited to own electronic arts, but right about now, I don't see a bunch of willing buyers coming in, driving prices even further. It almost feels like everyone that bought back here is super happy taking a profit and unwinding at the 200-day and then just moving on to something else. And I can assume that because the price isn't going up anymore. And if all of us wanted to go and buy a bunch of electronic arts, then the price is going to go up because the demand has increased. And you almost see an evaporation of demand or an evaporation of buying power on this chart. So certain of my mentors, like John Murphy, if I remember right, was just like the next day you want to see a little further move. Like people like Larry Williams, if I remember right, it was a percent of some sort, or it was like a certain amount that it would go above there. I remember with Tom DeMark, it was trading at least 1 or 2 ticks higher the next day. I tend to keep it a little less objective and a little more subjective. And I basically look at the chart and see, does the chart tell me that more people are trying to continue that move, or I'm seeing signs of trend exhaustion? And so with the chart of electronic arts, I would say a lack of follow through. We closed through the 200-day, and that has been it. So until we really just continue and push above like 146 and get out of this little range, I think the trend is stalled out for now. So that's the idea of follow through. And again, I would point you to books by John Murphy, by Tom DeMark. They all talk about this concept of follow through and have more specific rules. Some of them, others, it's more like with John Murphy, a little more nebulous, if I remember right. But for me, I think my general takeaway from working with them was, if you just look for a breakout and then buy it, you'll be wrong a lot. If you wait for follow through and just validate that breakout was good, your chance of success is much higher. And I've certainly found that in my own investing. All right. Next question. What are your views on April's positive seasonality? You had a longer comment about, I remember that question about seasonal tendencies. But let me take a look at the SPY. So I'm using stock charts for this. I'm going to go 20 years, which is just as much data as I can bring on here. And what you're asking is April, right? So if you look across the 12 months of the year, ending, 2005 to 2024, a 20-year period, basically ending at the end of last year, 3 months stand out as the most consistently positive months, right? With the best batting average. And that's what the number represents here. That's what the histogram is measuring. What percent of the time, it's the hit rate. What percent of the time is it up? So April, July, and November, the 3 strongest months in the last 20 years, clearly, right? In terms of their hit rate, and also in terms of their average returns. And that's actually the mean return is the number that you see down here at the bottom. It might actually be kind of hard to see. I'll make that a little bigger. Maybe that's a little more legible, but you can go to stock charts and look for their seasonality tool. So there's basically, we're looking at April with an average return of 1.9%, July with an average return of 2.6%, November with an average return of 2.5%. So those are your 3 strongest months, 3 most commonly up months, 3 best averages, but also 3 best returns. And again, those are mean returns. So I'm sure some months were down, but this is just the average return over time. So the idea is, April's usually a pretty good month. That's 100% true. Now, what we can also do, though, is start to fine tune this a little bit. So 2025 is a post-election year. So let's only look at the post-election year. So I'm going to start deselecting everything other than 2001, 2017, 2013, 2009, 2005. All right, now we're just looking at post-election years going back to 2005, and we can see that April is still one of the four best months for sure. It's actually second best behind July, so average return of 3.3% in a post-election year. Again, up 8 out of 10 times, or in this case, right, 4 out of 5. May has been positive every post-election year going back to 2025. So the seasonality, I would say, however you slice it, pretty good for April. My concern, right, is seasonality, and this is what Jeff Hirsch, who's the editor of the Stock Traders Almanac. When I think seasonality, Jeff's like the expert. His father, Yale Hirsch, literally pioneered the concept of seasonal tendencies and popularized a lot of the stuff we all kind of take for granted. So Jeff kind of knows this space very, very well. He will tell you these are tendencies. These are not absolutes. There's no guarantee that April is up or down. They're tendencies. And so what I would say is barring any extenuating circumstances, right? If nothing else comes out that would change the behavior from kind of the normal pattern, April should probably be a pretty good month. What happens in April when you have a new president going tariff crazy and with little or no warning before impact and a lot of uncertainty? You have the Fed kind of pausing, but not quite sure what they're going to be doing. We have inflation data that is suggesting areas of concern, earnings starting to be questionable, geopolitical risk elevated, and Q1 was down, apparently, unless Monday's a huge up day. Q1 probably ends up being a down quarter. What's the average at that point? I mean, the problem is that just hasn't happened that many times. And so seasonality is all about looking at average patterns. But, again, talking with Jeff, and the last time I interviewed Jeff, I asked him, we actually talked about this particular point, which was their tendencies. So the idea is, barring some one-off thing, this is what's probably going to happen. But one-off things happen a lot. And that's the challenge. And that's why I think seasonality is interesting as a backdrop. Trend is way more important than seasonal tendency. So if the trend is down and I'm seeing plenty of reasons to be bearish, I'm not going to stop being bearish because the seasonality seems good. That just tells me this is when we normally have a rally, which means if we don't, that confirms the fact that this is a super weird year. I don't know about you. It's felt like a weird year so far in 2025. So that's my take on seasonality. But again, you're absolutely right. If we don't get any further headlines that shock the market to the downside, maybe April ends up being a pretty good month because of that seasonality. That's fair. Again, I'm concerned about all the other things. Next question: can you review the Pring Bottom Fisher indicator as it's still going down? Yeah, I often get questions about this when the market's going down because it's an indicator, as you can probably guess. It's sort of implies we're fishing for a bottom. All right, so give me a second here to set this up. Let's see. We're going to bring up the indicator here. It's called PRB Fish. And then we can get rid of that one. There we go. So this is an indicator called the Pring Bottom Fishing Indicator. It's an indicator created by Martin Pring, designed to really identify lows in the market. And the general idea here is when the indicator gets really low and then starts to turn higher. It's kind of like the Kappa curve. You can see it lines up pretty often with some major lows and or at least some tradable lows in the market. That's totally fair. But do you know what this indicator is actually doing? I mean, the concept isn't bad. I think this is a decent concept. But when you actually understand what it's doing, I don't know if you're going to feel that great about it. And I'll tell you why. What this indicator actually does, and there's a good article about this on Stock Charts. Let me see if I can track that down. Pring Bottom Fisher. What it basically does, it looks at the members of the Dow 30, and it basically says how many of them are in a weaker momentum category. So here's kind of like an idealized pattern, and Martin Pring uses what he calls the KST indicator, which is a momentum indicator he designed. It's a proprietary indicator, kind of like an RSI, MACD, stochastics kind of thing. But KST stands for no sure thing, and it's It's his proprietary way of measuring, trend and inflection points. And basically, you kind of have this idealized cycle where something's going down, then it starts to bottom up and go higher, and then eventually it's in an uptrend, and then it starts to slow down and roll down. And so he can, using the KST indicator, identify which stocks are in which of these phases. And the bottom Fisher indicator basically says out of the Dow 30, those 30 stocks, what percent of them, or how many of them actually are in these sort of bearish groups. The idea is if most of the Dow names are going down and then it starts to turn up, that means a lot of them have kind of gone in a downward phase, but that's starting to change. And so the idea is the Dow 30 are in a downtrend and then they're kind of not as much anymore. But having said that, it's looking at the Dow 30, which again, if I'm going to make a breadth indicator, I would probably not do it on the Dow 30. The logic of it is these are big established companies, and so it's a good, interesting group to look at. However, it's sort of giving a general buy signal right here as the markets are turning down. It's an equal weighted measure of those 30 stocks. So again, I think the problem it would have with this particular market is I don't know if this is necessarily the basket of stocks I would be watching to determine when the major indexes are going to go down. Making a bottom fishing indicator on the Magnificent Seven or something, that's interesting. Making a bottom fisher on the NASDAQ 100, that actually might be something that's in stock charts. I don't know, something I'll look at. But that is what this indicator is doing. It's a great name of an indicator. And if you go back in history, it's had some great signals at identifying major lows, but that's the methodology that it's using. So for now, it's basically saying we're starting to see an improvement. I would guess that's because of the non-growthy stuff that's probably starting to look a little bit better, would be my guess. But that's the indicator, and that's what it's actually trying to accomplish. All right, we'll continue going here in a minute. As a reminder, friendly reminder, I mentioned the weekly flight plan earlier today. We have a premium membership at Market Misbehavior. My goal is to give a small group, a small subset of people that follow my work access to, custom or proprietary reports only for members, our weekly flight plan and our monthly chart review, a members only community where you can ask questions. And I'm in there sort of having an ongoing running dialogue with a lot of my premium members, and also a bunch of virtual courses where I teach you different indicators, different techniques, different routines, how I analyze charts, and going through step-by-step, breaking things down. If you want more information about those premium memberships, would love to have you. If you're up for it, go to marketmisbehavior.com, which is my website. In the upper right, click on Become a Member. This will tell you all you need to know about pricing, about all the benefits, about how to sign up. Has all the details on there. There's a 30-day money back, no questions asked guarantee if you want to give it a shot. Make sure if you do it, use the code YouTube when you check out for a special deal on your first 12 months on any plan. So check it out. Would love to have a couple of you join as a premium member today. Why not? All right, let's continue on. 3 more questions, and then we'll call it a weekend. Apple broke below support at $220 before regaining it this week. When does a prior support and resistance level no longer become important after it doesn't hold? That's a really good question. Let's look at the chart of Apple, which I just happened to have up here. You had said right below 220. Yes, you're kind of highlighting this level here. Let me do a big horizontal line so we're all on the same page. You're saying 220. Yeah, right. So you're saying, right, this is a level, and we talked about this on the show. I think you mentioned that in your question. And a lot of times with your questions, they're just too big to fit on a screen, so I have to edit for length. But I remember you said, I'd mentioned earlier that 220 level, which I remember that's called a pivot point, which is a level where you often find resistance and support. So once a level is support, when you break below it, it often becomes resistance. And so that's why that level was pretty important. And then, as you mentioned, we broke above it this week. For the record, today we actually closed below it since you sent your question in. But when when does it no longer become meaningful, right? When does a level no longer become meaningful? So here's the thing. I mean, I would say the general takeaways I would have would be, when you're looking at a chart, I always encourage people, read a chart right to left. And I was lecturing earlier this week actually yesterday, the students at Texas A&M. So shout out to the Aggies in College Station, and hope some of you are tuning in today. But it was awesome to sort of talk through analyzing charts technically and different tools and techniques that I use in my process. And what we're looking at here is we talked about how when you analyze a chart, you don't read left to right like you would read in English. You want to read right to left, right? So you want to start at the current price, look at where we're at relative to where we've been. And so I would say the further to the left you get, the less that level has memory, right? Because the idea with support and resistance is that the market has memory. A level has meaning to at least a cohort of investors. And as a result, that's probably going to affect or impact their analysis, impact where they place orders, those kind of things. So that's why support and resistance levels are widely followed, because it just has tended to work so many times because of that fact. Having said that, I would say, the further to the left you go, the less meaningful. When there's a bunch of price, does this high mean a lot from June of last year? I would say no, because I don't think anyone today is using that as an anchor to why they're doing it. Do these lows, which are kind of more recent lows, I would say 100%, right? This low right around here, people are going to know those levels because they're current, they're more relevant, they're more recent, and there's not a lot of other noise between the current price and those points. At some point, what I usually do is I eventually delete levels because they're no longer meaningful, right? And when I look back and I see the low or the high that they're notated on, when I feel like the current, if I'm analyzing the chart, if that level is not that important, I kind of get rid of it. So is there a time frame or a specific rule? Like, no, because if something has been in a long uptrend for a while and then finally turns lower, a low from like a year ago could actually be meaningful if there just hasn't been anything else to go off of, right? So I think, the trend is also a part of that too. So if you kind of have like a big choppy, noisy market, maybe that gets a little too muddy and people would not pay attention to those kind of levels. Once a level is broken and it's kind of no longer, clearly the market's not respecting that level anymore, I usually stop paying attention to it. This one I probably will, and I'll tell you why. We broke down through it. We closed above it, but just like that previous chart, I think EA we looked at, no follow through, right? So after that big close above 220, that's pretty much been it. We haven't had any additional follow through. So I think 220 might still be a level I would watch on the chart of Apple. So that was probably a long-winded answer to say it depends. And I would say that's part of the art versus science of using support and resistance level. There's no hard or fast rule that I've used that I found helpful. It's more subjective about, again, putting yourself in other investors' shoes and thinking about what levels they might find interesting. Next question. You like to use the UUP. Can you expand on what it is and how to use it? Yeah, so the UUP is a dollar ETF that actually comes up because on the main dashboard on stock charts, that is what is in the currency section, or excuse me, it's actually under the bond section, and that was mainly because there wasn't a currency section. And I remember when we were redesigning this, we just didn't have a good place to put the dollars, so we put it there. It's a horrible reason, but it was the best we could come up with. We had the space. So the dollar index is here, but this whole front page, most of these are ETFs. And so to stay consistent looking at ETFs and not looking at random indexes or other data sets, so like the commodities, even though we could do like a crude oil or something like that, like a future, these are all ETFs. And we did that because individual investors who are the primary users of stock charts are often looking at ETFs. And so that seemed to be a great way to do it. The dollar ETF, UUP, is not the perfect way to analyze the dollar, but it's not bad. It's basically based on the dollar index. And years ago, the stock charts didn't have real-time currency data. And so the UUP was actually updated during the day, and $USD, which is the dollar index, was only updated at the end of the day. So to get an intraday read on whether the dollar was up or down, you just look at a bullish dollar ETF, and the percent differences would be comparable enough that it was a close enough kind of proxy for tracking the dollar. So I have it up during the day just from old habits. I think if you look at $USD, which is the and stock charts does now have real-time currency prices. So $USD is going to update during the trading day and give you a good read on the dollar index. So that's basically what the UUP is doing. It's a bullish dollar ETF that is designed to model the movements in the dollar weighted index. That's kind of it. Generally, if I'm comparing returns of like the dollar versus gold versus stocks year to date, I would use $USD, because any sort of ETF linking to a currency or a commodity or a future or something like that, there always can be some subtle differences between the net asset value of the index, or of the ETF, or how they're using derivatives to replicate the performance of some non-tradable index. There's always some translation issue that will happen in there where it might not perfectly match it. So if you can look at the raw data, like the US dollar or crude oil or something, that's usually better. But UUP is just a quick, easy way to say, is the dollar up or down on a particular day? That's your answer. Someone mentioned K1s. I would say with UUP as an investment vehicle, it's not something I've used in my own portfolios. Anytime you have currency, commodity, futures kind of ETFs, that can be an issue. The tax implications of just the structure and how it's issued. And so K1s, and someone mentioned, I haven't verified that. I'm assuming what you're saying is true, but I know with a lot of currency and commodity ETFs, you have a K1 involved, which has some tax implications. So yeah, no, I would say do plenty of due diligence on the UUP. That's not a product that I use for trading. I use it more for an indicative read on what the dollar is doing. Final question, then we'll call it a weekend. What trend reversal patterns should one look at when equities are at a low versus a high? Same indicators and patterns, or a different set? That is a really thoughtful question. I appreciate that so much. And it reminds me of, in my Fidelity days, one of the things I would do would work with people who are starting to manage a fund for the first time. And they would actually have to write up a one-page prospectus, kind of like a mission statement. Like, here's what the fund is going to do. Here's how we're going to do it. Here's what information we're going to take. Here's how we're going to manage positions. Here's how we're going to manage risk, et cetera, et cetera. This is the kind of the turnover we're aiming for. And it was just a way of laying out a game plan for how you're going to manage this fund, as opposed to just rolling the dice and seeing what happens and changing your mind randomly. It was to give you a structure that you could innovate on, that you could change and evolve, but give you a good starting point with which to sort of get started. So by asking about, one of the questions we would always ask is, what's your sell discipline? Is the sell discipline just the opposite of the buy discipline, right? So if I'm trying to buy undervalued stocks, is my sell discipline, I'm looking for overvalued names that I own, or something like that. So that's great, because I think a lot of people oversimplistically think that the opposite of a buy signal is always going to be a sell signal. But the reality is, stocks actually make tops and bottoms in some different ways, right? One of my mentors, Ralph Hackenpour, would love to quote, markets go up the escalator and down the elevator, right? So the idea is things tend to grind higher, but often will roll over very, very quickly. So recognizing those differences can be helpful. So what does that mean in practice? So I would say, in general, what I often tell people when they're trying to back into, or when they're trying to figure out reversal techniques or identify turning points, find a chart that represents where you would have loved to have bought. And so, like, let's say my goal here is, I want to be selling Home Depot in late March. I want to be buying Home Depot here in late April. And so I just want to look at indicators that would help me identify these are extremes, at which point I want to start rotating. So then look at different indicators and see which indicators would help you, would have helped you figure out those points, or which would have helped you identify those points. You can't stop there. You then have to kind of back test it, right? And either statistically back test that, or look at a bunch of other random charts, out of sample charts, and just apply those same techniques and see what sort of insights you could have gotten. But that's what I always tell people, especially for like scanning and screening for ideas, is look for indicators that would have helped you identify certain turning points. And that could be a starting point for a journey of finding the right answer. A couple things I will tell you, though, like divergences, I found are way more common at tops than at bottoms. So when I'm looking for topping signals, like Home Depot making higher highs on weaker momentum, we've seen so many divergences in the last 4 to 5 months. Going into year end, in the first month or two of this year, the S&P itself making a new high in February on weaker momentum. So I found bearish divergences happen really often at tops. I've not found bullish divergences are as frequent, right? I don't see that particular scenario playing out as often, although it does, right? Here's Home Depot, and you can see a bullish momentum divergence right here. But that's one of those things that generally I think of that as more of a topping indicator than a bottoming indicator. So things that are helpful looking at major lows, I would say number one, looking at some measure of momentum, looking at things like RSI or stochastics and identifying things that are at the lower end that have gone down a lot more than expected. The problem that you will have, though, is that in a downtrend, if what we're seeing right now is just the beginning of a protracted decline, indicators like that can become oversold or very low and then remain there for quite some time. So what I would also tell you is you always want to be looking for signs of accumulation. I always think of indicators like PPO as being particularly helpful at a low. Something like RSI will often be like an early warning telling you things are down a lot. Something like a PPO indicator, particularly the weekly PPO, is like my go-to, bottoming indicator. This is what I tend to use more than anything as a more of a longer term approach, is look for things that have been down a lot. And then you get a buy signal from the weekly PPO. And that usually tells you the bottom is in and we're now in a recovery phase. So those are a couple ideas to get you thinking. I would say number one, the indicators could be very similar. Something like PPO is designed to give sell signals and buy signals and sort of give these binary signals back and forth. But in practice, I find there are certain indicators that are go-to indicators for me at major highs and the other ones at major lows. And I would say particularly at lows, I think something like momentum is good to get things on a list of, so very beaten down momentum, oversold names, kind of get on a list of potential ideas. And then buy signals from trend following indicators can confirm that the bottom is probably established and that we're starting to rotate a little bit higher. Those are some ideas, but I appreciate that question. That's a really thoughtful question. Again, I would encourage you guys to compare buy signals and sell signals, and don't just assume that they're inverse of one another. They can actually be very different. All right, folks, that'll do it for this week. Thank you so much for tuning in. Those of you doing it live, sorry again for the late kickoff. I should have planned better, but man, life gets in the way sometimes. I'm thrilled we have the technology to still be doing the show when we can. Thanks for joining me this week. Great podcast this week, including a conversation with Craig Johnson that actually we just edited. I should have it out to you here in the next hour or so. Listen to that one because we talked a lot about his approach. He works with institutional investors, how they are navigating this corrective move. Some interesting ideas I think you'll appreciate. Have a great weekend. For Market Misbehavior, I'm Dave Keller. Remember, it's always a good time to own good charts. Take care, everybody.